Alphabet, which is the parent company of Google, just released their 10Q report, which is the quarterly report US companies have to report to SEC for their second quarter of 2023. And we are going to go over it together. If you want to download the report yourself, you can find the links in the description. Since I'm an owner of Alphabet, one of the first things I do is update my list of ownerships with some data that are important to me. And one of them is how much of the company I own. 3 months ago, I owned 1 in 84.6 million of Alphabet, which is dividing the number of shares outstanding, which was 12.7 billion, by the number of shares I own. They do share buybacks, so the number of shares should have gone down since the last report, and I should now own a bigger slice of the pie without buying any new shares in the past 3 months. So let's create a copy of the list here for comparison. They have 3 different classes of shares, and 3 months ago the sum was 12 billion and 697 million. The latest report shows a reduction of total number of shares to 12 billion and 609 million shares, which is an 88 million reduction, and now I own 1 in 84 million of Alphabet. This is impressive. Without spending any money or buying any shares, now I own a bigger slice of the pie. Before going into the report, we should note that Form 10Q contains forward-looking statements, which means things may not happen the way they expect it to happen in the future. So bear that in mind and read this part for better understanding of their business. It's always a good idea to start from the end of report and make your way toward the beginning. We can see in the last quarter they have bought back 131 million shares with 15 billion for average price of 115. Now, as you remember, their share outstanding was lowered 88 million. So where did those 43 million shares come from? Well, first there's a date difference between the quarter and the day when they report their number of shares out. So we have to keep that in mind. And second, and most importantly, they give stocks to their employees as a compensation, which we will see later on. If we look at their share buyback for the past 3 and 6 months, we can see they have spent 15.1 billion and 30.2 billion respectively, and bought back 131 and 288 million of shares for an average price of 115 and 105 respectively. But they almost pay a third of that to employees as a stock-based comp and dilute us. So the actual price is closer to 170. I hope this is something that they fix soon and stop paying crazy amount to employees, which is something that some activist investors have been pushing for. And they still have 68.1 billion remaining on their share buyback program. They still have 442 million unvested stock-based awards to employees, and it increased 36% compared to 6 months ago. A stock-based comp is one of the worries that investors in Alphabet should have, so I would suggest keeping an eye on this number and use it in your calculations. It does not seem like a big number compared to their 13 billion share outstanding, but it's a 20 billion yearly cost right now, which is 7% of their revenue. They have some fines to pay, which is a good thing to know. They have a monopoly on search advertisements, so it's expected that governments will fine them for infringing competition laws. They own 90% of search engine market share and take 60% of search ad revenue home. And some more antitrust investigation on Google that have been going on for more than a decade, and you can read more information about it here. Here we can see a summary of their cash flow statement for the past 6 months, which is very important. It shows us what part of the company creates the cash and which part used it. Their operating activity created 52 billion of cash from different businesses they do, which was 17% increase over the same period last year. 21% of that 52 billion is a stock-based compensation, which increased 19% over the same period last year. Hopefully with the 10% reduction of employees they did last year, this number will not move higher faster than they can create cash from operating activities. From that 52 billion, they spent 13.7 billion of it on investing activities, which include these things, and had 4% increase compared to last year. With a tougher economic conditions, it makes sense that they would invest less and be more conservative, and actually they have decreased increased their capex 21%. The amount they spend on capital expenditure is very important. Deduct this from cash from operating activities, and this is free cash flow, which is an important number for us shareholders, which will result in 40% increase in free cash flow. We just need to remember to deduct a stock-based comp too, and in that case it will reach 50% increase. The same goes for financing activities, which include these things. 34.4 billion in the last 6 months, which is the same as last year on the same period. One other info I keep for myself is the amount of trailing 12 months free cash flow they have. Before it was 61.91 billion, and now since it's increased by 9.19 billion, our new trailing 12 months free cash flow is 71.09 billion, which will automatically increase my income from my investment without me doing anything. They break down their revenue into segments like this, which majority is advertising with 112.7 billion. This segment only increased 1.7% compared to the last year's 6 months period. Google Other increased 16%, and the exciting part, which is Google Cloud, increased 28%, which gave them a 5% increase on the first 6 months of the year compared to last year. Here we can see what each segment includes. Google services include Google search advertising through google.com, Gmail, Google Maps, Google Play, YouTube ads, and Google Networks, which include AdMob, AdSense, and Ad Manager. Google Other includes Google Play revenue through sales of apps and in-app purchases, hardwares like Fitbit, Google Nest and Pixel, and YouTube non-ads revenue like premium subscriptions and YouTube TV. Google Cloud segments include Google Cloud Platform, Workspace like Gmail, Docs, and Drive, and other enterprise services. If we look at their breakdown by region, we can see no change compared to last year, and they still have almost half their revenue from US, 30% from Europe, Middle East and Africa, and 17% from Asia and Pacific. Their biggest expense, which is 43% of their revenue, comes as cost of revenue, which is traffic acquisition costs and some other costs. They still kept their great 57% gross margin. Research and development increased from 14% of revenue to 15%, which mostly comes from the increase in headcount and the 10% layoff expenses they incurred recently. Sales and marketing sits tight at 9% again compared to last year, and the same goes for general and administrative at 5%, which gives them a 28% operating margin, which is pretty good. They have started a workforce and office space reduction, which cost them 2.6 billion in the past 6 months, but hopefully would be worth it in the long run. They break down their operating income into segments too. All their profits come from their services, with a 3.7 increase compared to the same 6 months period last year, and with a 35 operating margins, which is in line with the last year's. And their cloud business is now profitable for 2 consecutive quarters, but for now has a very low margin at 3.8%, which I'm sure will grow over time. Their other segments are not profitable and probably never will be. Those are experiments and investment into new areas that they try out to see if they can create new business or not. Here we can see their effective tax rate has increased compared to last year from 14.5 to 16.7. And here we can see a summary of their income statement for the first quarter compared to the same period last year. They have 26 billion of cash and cash equivalents and 92 billion of marketable securities broken down like this. That is 31% of their 383 billion assets, which is impressive. They are very cash rich and they can pay their whole liabilities, which is 160 billion with it, which cannot get better than this. One of the big parts of their assets is property and equipments with 121 billion, and it's broken down like this. The amount of goodwill and intangible intangibles on their balance sheets is neglectable, sitting at 8% of their 383 billion of assets. You can see a breakdown of them here. They don't have any short-term debt, but they have 14 billion of long-term debt with different maturity and interest rates. So anyway, that was what I wanted to share with you on this video. Thank you for watching and hope you enjoyed it. If you did, make sure to smash the like button for the YouTube algorithm, subscribe to the channel if you have not done so already, and tap the bell button to get notification when I post a new video. Check out Simply Wall Street offer, link in the description, and try it out. They help a lot with your research on companies. And next, watch this video for the latest report on Meta, which is the other big player in advertising business. Have a great rest of the day and see you on the next one.